Hello guys, welcome to another episode of Crypto Fight. So in this session we'll be talking about some technical terms that you're going to be using in the future trading. So some are do's and some are don't. And yes. So we've heard what is future, we've get to know the future work environment, trading environment, and then how to choose trading pair to use. So now the next thing we want to do now is how to know some technical terms. So first, yes, is why users trade future contracts. Hedge and risk management. This was the main reason why future were invested. Hedging and risk management. So the next one is short exposure. Trader can bet against an asset performance even if they don't have it. So yes, future allow you to trade. I can trade thousands of pairs without buying the real asset. You understand? And leverage. Trader can enter positions that are larger than their account balance. Yes, like I said before, do I have $100 and I can enter position of what $2,000 using what leverage. So that means my let me try and open calculator. So by standard I have $100 and I use leverage of what 20,000 at $20 20% 20 times, sorry, multiple of 20, so that will be what 100 times 220 times 20, so that's what 2,000. So now that means this 100 divided by 20, this is 5. So that means if I'm using the leverage of 20 before the price reach, okay, let's say I long, you understand, I believe the price is going to increase later in the future. Before the price reaches increase or decrease to 5% of my entry price, then I will have got liquidated. It's not essentially that the price will reach 5%, you understand. And if I use leverage of time 2, so that will be what 100 divided by what 2. So now before the price reaches 50%, decrease to 50%, if I'm longing, if I believe the price will go up later in the future, then before it reaches 50%, at maybe 45 to 48, then I will have gotten liquidated. So that's the essence of using leverage. It's good that we get to know what we use leverage for and implication of what leverage. So now let's see leverage of 1%. 100 divided by what 1, you see what 100, you understand. So that means before your entry price, before its value go down by 100%, then maybe at 90 or 95 you will get liquidated. Now let's see for someone that use leverage of what 125, so divided by 125. So any slight change, any of maybe 0.5%, if you long, if the price go against you at 0.5%, you get liquidated. So selling short is very risky, one of the most riskiest, very risky. So when you are quite sure about the information of the market, the liquidity and then the volatility. When you are quite sure about that, you know what the trend will be, and you know how to use those things. So you can use the leverage of what 125%. That's what short burst, very short burst. So that's where you can use the leverage of 125. And not all assets have leverage of such extent. Not all assets. So some peers, I think BTC is among the peers that have that kind of leverage. So BTC is among the peers that have that kind of leverage. BNB, I do not know. Let's try and check for BNB. Okay. BNB. All right. Yes, 75. So if you know what you are doing, you are quite sure of yourself, you've done your analysis, fundamental and technical, you can do the short burst, but it's very dangerous. So, and that is it about leverage. So now, to know the point you are going to be liquidated, you have to know the percentage portion that will be removed from your asset as your trading fee and all those things. So that is it about leverage and why user trade future contract. So let's go to other technical terms. What are perpetual future contract? Perpetual future contract is a special type of contract, but unlike the traditional form of future, it doesn't have an expiry date. So like I said earlier on, it has no expiry date. So one can hold a position for as long as they like. Other than that, the trading of perpetual contracts is based on underlying index price. The index price consists of average price of an asset according to major spot markets and their relative trading volume. So for this particular asset now, this is the index price. So for this pair now, this is the index price. So the index price consists of average price of an asset, that's the average price, according to major spot markets and their relative trading volume. Thus, unlike conventional future, perpetual contracts are often traded at a price that is equal or very similar to spot market. However, during extreme market conditions, the mark price may deviate from spot market price. Still, the biggest difference between the traditional future and perpetual contracts is the settlement rate of the former. So that is it about the perpetual contract. So this is the index price, the average price between the buy and sell and others here. And mark price, I think mark price is the price you are entering, or yes, the index price you are entering. So what is initial margin? Another something to know is what initial margin. So initial margin is the minimum value you must pay to open a leverage position. For example, you can buy 10,000 BNB with an initial margin of what 100 BNB at leverage times 10. So now, what initial margin meant is, suppose this is BNB, you understand, and then you want to buy, like this the explanation said, 10,000 BNB, you need to have what 100 BNB. So 1,000 divided by 100, you understand, you want to use 100, meanwhile you have 100, meanwhile you want to use 1,000. So that means you are going to use 10 times leverage, you understand. So what you brought in and the minimum required to enter position, to open any position is what is the amount you pay to open position is what the initial margin. So there should be minimum margin. Definitely minimum margin is the minimum amount you can bring into the market to open trade, even at one leverage. So that is it about margin. This margin is what back your leverage position, acting as collateral. Like I said before, for your position to be valid, you need something. You need to bring something in. So that's what they call collateral. So your collateral is what you're going to leverage and what you're going to use on the trade. Okay, maintenance margin. Let's see, what is maintenance margin? It says maintenance margin is the minimum amount of collateral you must hold to keep trading position open. If your margin balance drop below this level, you either receive a margin call asking you to add more funds or be liquidated. Yes. So the maintenance margin can be, in most cases, it's usually your initial margin. Understand? So maintenance margin is usually your initial margin. Like we said here, let's assume you are using short burst mode, leverage of 125. Your maintenance margin, once it reach or decreases, so suppose you are selling, you are longing, you are buying, you are longing, and then the market is going against you. You understand? And let's assume your liquidating price is what? Liquidation percentage is 0.7. You understand? Once the market goes against you at 0.7%, it's going to liquidate you. Meanwhile, once the trend follow the trend you want it to go, maybe you are buying long. You understand? Once the trend follow the long, then definitely you are making profit as well. So by the time it reaches 0.7 or 0.8, you'll have doubled your asset, the asset that you brought in. That's what your initial margin, and then the initial margin actually. So the maintenance margin is the money you have to keep in the market to sustain you. So usually your maintenance margin is usually lower than the multiple of your liquidating price and then the leverage. I don't know whether anybody understands what I'm saying there. So your maintenance margin for this $100 may be $90 sometimes. You understand? So once it reaches that $90, because Binance has to remove its own trading fee as well, so it will liquidate. So that's maintenance margin for you. Maintenance minimum amount of collateral you must hold to keep trading position open. So that's it about maintenance margin. Okay, in other words, initial margin is the value you commit when opening a position, and maintenance margin refers to the minimum balance you need to keep your position open. So the maintenance margin is a dynamic value, okay, that changes according to the market price and to your account balance collateral. So like I said, it's dynamic, it's not static, it changes. So okay, it says the minimum amount of collateral you must hold to keep. Yes, all right. If you feel I'm getting it wrong, please put it in the comment section. So, but I believe I'm right about it. Liquidation is the value of your collateral. If the value of your collateral fall below maintenance margin, your future account may be subject to liquidation. Like I said back then, the maintenance margin, once your position, the value of collateral fall below the margin, so your future account may be subjected to what? Liquidation. So depending on the exchange you use, liquidation occur in different way in general. So liquidation changes according to risk and leverage of each user. The larger the total position, the higher the required margin. So one thing to do, as is clearly stated here, is to close your position before liquidation price is reached, or add more fund. When you add more fund, you are likely to lose more fund. So what is funding rate? Funding consists of regular payment between buyer and seller according to the current funding rate. When the funding rate is above zero, traders that are long have to pay one that are short. In contrast, a negative sum of funding rate means that short position pay long. So what basically happens in the future market is, as you are longing, you believe the price will increase later in the future. Understand? When you believe that, some people, they are betting against you that the price will go down. As you are going up and the trend is going against those people, they'll be the one to later sell to you. You understand? So in the future market, some people are gaining and while some people are losing. Something is compensating the other. So you are trading against other trader. So your own is that the value of the asset is going to increase, while their own is that the value of the asset is going to decrease. So whoever win over time, we get to pay the other. So that is it. Mark price. Mark price is an estimate of the true value of the contract, fair price, when compared to its actual trading price, last price. The mark price calculation prevents unfair liquidation that may happen when the market is highly volatile. So while the index price is related to the price of the spot market, the mark price represents the fair value of perpetual future contract. Typically, mark price is based on the index and the funding rate, and it's also an essential part of the unrealized profit and loss, P&L. We call it profit and loss. So that is mark price explained. So mark price wants to look like the index price, but actually mark price is, I believe, is the price that you enter the market, and it's going to be the one to decide whether you are going to get liquidated or not, itself with the trend of the market. What is P&L? Yeah, am I right? Alright, if you feel I'm alright, please put it in the comment section. So what is P&L? P&L stands for profit and loss, and it can be either realized or unrealized. When you have open position or on the perpetual future market, let's see P&L, profit and loss. There's no position opened, but it's usually shown around here. So it's usually shown around here. Later on, when position is open, we get to see what P&L and mark price are. Because the realized P&L refers to the profit or loss that originate from closed position. It has no, so that's realized. Okay, let me go back. Your P&L is unrealized, meaning it's still changing in response to market move. And then when you have open position on the perpetual future, your P&L is unrealized, meaning it's still changing in response to market move. When you close your position, the unrealized P&L become realized P&L, either partially or entirely. So when you trade, you profit or loss. So when you've not attained any of the two, is unrealized. When you've attained any of the two, is realized. And whatever you realize may be loss or profit. So because the realized P&L refers to the profit or loss that originate from closed position, it has no direct relation to the mark price, but only to the executed price of the order. The unrealized PLA, on the other, is constantly changing as primarily driver for liquidation. Thus, the mark price is used to ensure that the unrealized P&L calculation is accurate and just. So the mark price, like I said, is your entry price, and that one usually will remain what? Stable, though the index price may change over time. The index price will determine the index price relative to your mark price will determine whether you are profiting or you are losing. What is insurance fund? Simply put, insurance fund. Simply put, insurance fund is what prevents the balance of losing trader to draw below zero, while also ensuring that winning trader get their profits. So that's it about the insurance fund, and that's the back end side of the Binance. They only know how to do all those things. And what is auto deleveraging? Auto deleveraging refers to a method of counterparty liquidation that only takes place in insurance fund stop function. If the insurance fund stop function during specific situation, although likely such an event will require profitable trader to contribute part of their profit to cover the loss of losing trader. Unfortunately, due to the volatility present in the cryptocurrency market, it's not possible to fully afford this possibility. Auto deleveraging. Alright, so I believe that is it about future trading. Those are some of the technical price terms. This is a index price. So if I enter at this index price, that's going to be my mark price. So depending on whether I buy or sell, and then relative to the future index price, that will not determine my profit or loss. And this is limit if I want to buy at a given price, and this is market if I want to buy at a current market price. So sometimes market price we execute the order immediately, and we put you and buy you a future contract, while the limit we wait to the till the market get to that particular index price that you want to buy. So, and it's going to mark it and buy it for you to become your mark price. So that is it about some technical terms used in some terminologies. Yes, there are technical and terminologies used in future trading. Now, for future, for technical analysis of the chart, you get to see that later in the future video, and then how to use the order book to trade. So the order book, I get to realize that after losing some amount of money, and yes, lesson learned and well learned. So thank you guys, and see you in the next video.